Analysts generally view Pavilion REIT's 2014 financial year results as within expectation, but are less bullish over the outlook for 2015 due to the weakening ringgit and impending GST. Most of them have maintained their hold recommendation on the stock. Pavilion REIT announced a core net profit of 232.4 million ringgit and a net profit growth of 7.5% year-on-year, driven by positive rental revisions, newly completed renovations at Pavilion KL Mall, and higher service charges to tenants. This was despite a 6.2% increase year-on-year in property expenses due to higher utilities and assessment expenses. AM Research notes that the company's 34 million ringgit capex this year will be centered on upgrading equipment to reduce energy usage. The research house also foresees flat retail sales due to the softening of consumer spending post-implementation of GST. HLIB Research is of the view that continuous asset enhancement initiatives will be a boon for Pavilion to weather the challenging outlook in the retail sector. RHB Research, meanwhile, expects overall revenue growth to remain stable in financial year 2015, with more than 90% of its rental based on fixed rental. The research house maintains its neutral rating on the stock despite uncertainty over GST impact on retail sales. CIMB Research also notes that the 2015 outlook remains challenging, underpinned by GST and the falling ringgit against US dollar, which will affect the prices of imported goods. It maintains its whole call on the stock, but prefers Axis REIT. Kenanga Research, however, says it likes Pavilion REIT for its prime asset positioning, which will provide it with some resiliency when GST kicks in. Kenanga believes that the company can weather the effects of rising inflation better due to its shoppers' higher purchasing power. She and Shannon, The Edge TV.